plant asset, natural resources, and intangibles. The first thing that we're going to learn to do is to compute the cost of plant assets. So first of all, what is a plant asset? Well, a plant asset is a tangible asset, meaning that it's something that we can touch and we can see, that is used in business operations, and it has a useful life of more than one accounting period. So that means that we're going to use it usually over the course of many years. Plant assets are also called plant and equipment, property, plant, and equipment, or fixed assets. For many companies, plant assets make up the largest class of assets that they own. There are four issues in accounting for plant assets. First is computing the costs of plant assets. The second would be allocating the costs of plant assets, and then accounting for the expenditures to plant assets and recording the disposal of plant assets. And so we see that there's a decline of the asset book value over its useful life. So for example, they purchase a vehicle for their business, or obviously even yourself, it's now no longer worth what it was when you purchased it, and it continues to decline in value. So we'll talk about that some more. So cost determination. Plant assets are recorded at the cost when acquired. Now, cost includes all normal and reasonable expenditures necessary to get an asset in place and ready for its intended use. So that would include the cost of a machine, for example, includes its invoice cost less any discount, plus the necessary shipping, assembling, installing, and testing costs. Examples are the costs of building a base for a machine, installing electrical hookups, and testing the asset before using it in operations. So you may purchase a large machine, it has to be bolted to the floor. Maybe you have to have 480 volt electricity ran to it, etc. And how you also have to test it before you can actually start using it to manufacture whatever. So all of those things would be considered part of the cost, also the cost of getting it to your location. So machinery and equipment. The cost of machinery and equipment consists of all costs normal and necessary to purchase them and to prepare them for their intended use. This includes purchase price, tax, transportation charges, the insurance while it's in transit, and installing, assembling, and testing of the machinery and equipment. Buildings. A building account consists of the cost of purchasing and constructing a building that is used in operations. When purchased, a building's cost usually includes purchase price, taxes, title fees, and lawyer fees. Its cost also includes all expenditures to ready it for its intended use, including necessary repairs or renovations. So if you purchase a building that already exists, you're going to want to have it remodeled for your intended use. So maybe you need more outlets put in, maybe you want some cabinetry put in, maybe you want it, repaint and new floor. All of those things would be things that would be included in that initial cost, because you're doing that to get it ready for you to occupy. Now, when a company constructs a building or a plant asset for its own use, so starting out from just a plot of land and they're building a building, its cost would include materials and labor, plus indirect overhead costs. Overhead costs include heat, lighting, power, and depreciation on the machinery used to construct the asset. Costs of construction also include design fees, permit fees, and insurance during construction. Land improvements. Land improvements are additions to land and have limited useful lives. Examples are parking lots, driveways, walkways, fences, and lighting systems. Costs of land improvements include the cost necessary to make these improvements ready for their intended use. And then land is the Earth's surface and has an indefinite, unlimited life. Land includes costs necessary to make it ready for its intended use. When land is purchased for a building site, its costs include the total amount paid for the land, including any realtor commission, title insurance fees, legal fees, any accrued property taxes paid by the purchaser. Now, payments for surveying, clearing, grading, and draining are also included in the cost of the land, because those are all things that you would have to do before you build a building there. Other costs include government assessments, whether incurred at the time of purchase or later, for items such as public roads, sewers, and sidewalks. Because oftentimes you have to pay that when you come into a new area, and it helps for that. These assessments are included because they permanently add to the land's value. The cost of removing structures, less amounts recovered through the sale of salvaged materials are charged to the land account. So if you have a building there, maybe there's certain parts of the building that maybe you can salvage, so you would subtract that, but you would, the cost of the demolition would be charged to the land account. Okay, lump sum purchase. Plant assets sometimes are purchased as a group in a single transaction for a lump sum price. This transaction is called a lump sum purchase, or group, bulk, or basket purchase. We allocate the cost to the assets acquired based on their relative market or appraised values, which can be estimated by appraisal or by using the tax-assessed valuations of the assets. So for example, let's assume that CarMax paid $90,000 cash to acquire a group of items consisting of a building that was appraised at $60,000 and land appraised at $40,000. The $90,000 cost is allocated based on the appraisal values shown on the slide. So $60,000 of it would be toward the building, and then $40,000 would be toward the land. You could separate those out. So now, computing and recording depreciation using the straight line, units of production, and a declining book balance methods. Depreciation is the process of allocating the cost of a plant asset to expenses while it is in use. Depreciation does not measure the decline of the asset's market value or its physical deterioration. So it's allocating the cost of the plant asset to expense it while it's in use. Now, factors that determine depreciation are cost, salvage value, and useful life. So cost is the cost of a plant asset consists of all the necessary and reasonable expenditures to acquire it and prepare it for its intended use. Salvage value, also called residual value or scrap value, is an estimate of the asset's value at the end of its useful life. This is the amount the owner expects to receive from disposing of the asset at the end of its useful life. If the asset is expected to be traded in for a new asset, its salvage value is the expected trade-in value. Because oftentimes we'll do that with vehicles, or we'll do that maybe a company will maybe lease equipment, lease copiers or something, and so they'll trade those in towards the purchase of the new ones. Okay. Useful life. The useful life of a plant asset is the length of time it is used in a company's operation. Useful life, also called service life, might not be as long as the asset's productive life. For example, the productive life of a computer can be 8 or more years. But some companies, however, will trade in old computers for new ones every 2 years. In this case, these computers have a 2-year useful life, meaning the cost of these computers less their expected trade-in values is charged to depreciation expense over a 2-year period. So even though something might, like an example of a computer, it might be able to still be used for up to 8 years, companies for different reasons decide maybe to replace them every 2 years. So 2 years would be in this example, would be the useful life. Okay, depreciation. Depreciation methods are used to allocate the plant asset's cost over its useful life. The most frequent used method is the straight line method. The units of production and double declining methods are also commonly used. We explain these 3 methods in this section. The computations in this section use information about a machine that inspects athletic shoes before packaging. Manufacturers such as Reebok and Adidas use this machine. Data for this machine is presented on this slide. We use this to illustrate depreciation using the 3 methods listed. Let's begin by looking at straight line depreciation. So we see here that they purchased a machine. It's going to cost $10,000. We'll only be able to get $1,000 for it once we scrap it, probably scrap metal price. So depreciable cost is $9,000. It will be used for a useful life of 5 years, and the units that it will inspect 36,000 shoes. So the straight line method. The straight line depreciation charges the same amount of expenses to each period of the asset's useful life. A two-step process is used. We first compute the depreciable cost of the asset, also called the cost to be depreciated. It is computed by subtracting the asset's salvage value from its total cost. Second, depreciable cost is then divided by the number of accounting periods in the asset's useful life. And so we see that if this machine was purchased on December 31st of 2018 and used throughout its predicted useful life of 5 years, the straight line method allocates an equal amount of depreciation for each year for the years 2019 through 2023. We make the adjusting entry shown above at the end of each of the 5 years to record straight line depreciation of this machine. The $1,800 depreciation expense is reported on the income statement under operating expenses. The $1,800 accumulated depreciation is a contra asset account to the machinery account on the balance sheet. So we figured out that they had $9,000 of what they were going to be able to depreciate in total, divided by the 5 years of service life. We know that they're going to be able to depreciate $1,800 a year. So we would have depreciation expense in the amount of $1,800 debit, and we would credit accumulated depreciation machinery $1,800. The graph on the left of this slide shows the $1,800 per year expenses reported in each of the 5 years. The graph on the right shows the machinery account balance net on each of the 6 December 31st balance sheets. And so let me read this next paragraph and we'll look at the slide. The net balance sheet amount is the asset book value, or simply book value, and is computed as the asset's total cost less its accumulated depreciation. For example, at the end of year 2, December 31st of 2020, its book value is $6,400 and is reported on the balance sheet as shown. So we see here the depreciation expense on the income statement that will remain constant, but we see that each year the year-end book value decreases by the accumulated amount of depreciation. So we start at 10,000 at 82, and then it goes down. And then in 2023, 1,000. And then on the balance sheet, you would see machinery, 10,000, and then less the accumulated depreciation of 3,600. So the machinery, then the book value is $6,400. Now note 3 points in this exhibit. First, depreciation expense is the same for each period as we said. Second, accumulated depreciation is the sum of current and prior periods' depreciation expense. Third is the book value declines each period until it equals the salvage value at the end of the useful life. The unit of production method, two-step process. So when equipment use varies from period to period, the unit of production depreciation method can better match expenses with revenues. Unit of production depreciation charges a varying amount for each period based on an asset's usage. A two-step process is used. We first compute depreciation per unit as the asset's total cost minus salvage value, and then divide by the total units expected to be produced during its useful life. Units of production can be expressed in product or other units, such as hours used or miles driven. The second step is to compute depreciation expense for the period by multiplying the units produced in the period by the depreciation per unit. And so using data on the number of shoes inspected by the machine, we can compute that the units of production depreciation schedule that we see shown in this slide. For example, depreciation of the first year is $1,750, 7,000 shoes at 25 cents a shoe. We see here, this shows you how many shoes they're going to produce, the total that it is able to produce over the 5 years, and then dividing the cost out by how much they're able to depreciate by. You can get the depreciation per unit, and so then the depreciation expense, and then you can figure out the book value. Let me go back. So depreciation per unit is the cost minus the scrap salvage value, and then divided by the total units of production. That's how you get how much per unit. And then to figure out then how much the expense would be for each period would be the depreciation per unit multiplied by the number of units produced in the period. Declining balance method, 3 steps. So an accelerated depreciation method has more depreciation in the early years and less depreciation in later years. The most common accelerated method is the declining balance method, which uses a depreciation rate that is a multiple of the straight line rate. A common depreciation rate is double the straight line rate. This is called the double declining balance, DDB. So this method follows 3 steps. Compute the asset straight line depreciation, double the straight line rate, compute the depreciation by multiplying this rate by the asset's beginning book value. So to illustrate, let's use double declining balance to compute depreciation for our $10,000 machine with a 5-year useful life. This slide shows the first year depreciation computation for the machine. The 3-step process is to divide 100% by 5 years to determine the straight line rate of 20%, or 1/5 per year. Next, we would double that 20% rate to get the declining balance rate of 40%, or 2/5 per year. And 3, we would compute depreciation expense as 40%, or 2/5 multiplied by the beginning book value. Double declining balance depreciation schedule is shown here. The schedule follows the formula except for year 2023, when depreciation expense is $296. This $296 is not equal to 40% times 1,296, or $518.40. If we had used the $518.40 for depreciation expense in 2022, then book value would equal $777.60, which is less than $1,000 scrap value. Instead, the $296 is computed by subtracting the $1,000 scrap value from the $1,296 book value at the beginning of the 5th year, the year when DDB depreciation cuts into salvage. So we see here a comparison of the different depreciation methods. This table shows depreciation for each year under each of the 3 methods. While depreciation per period differs, total depreciation of $9,000 is the same over the useful life. The book value of the asset when using straight line is always greater than the book value from using double declining balance, except at the beginning and end of the asset's useful life, when it is the same. Also, the straight line method yields a steady pattern of depreciation expense, while the units of production depreciation depends on the number of units produced. Each of these methods is acceptable because it allocates costs in a systematic and rational manner. As shown in the above graph, about 80% of companies use straight line depreciation for plant assets, 5% use unit production, and 4% use declining balance. Another 6% use an unspecified accelerated method, most likely declining balance. How this affects tax. Many companies use accelerated depreciation in computing taxable income. Reporting higher depreciation expense in the early years of an asset's life reduces the company's taxable income in those years and increases it in later years when a depreciation expense is lower. The company's goal here is to postpone its tax payments. So the modified accelerated cost recovery system allows straight line depreciation for some assets, but requires accelerated depreciation for most kinds of assets. And it's not acceptable for financial reporting because it doesn't consider the asset's useful life or salvage value. Depreciation for a partial year and changes in estimates. So when an asset is purchased or sold at a time other than the beginning or end of an accounting period, depreciation is recorded for part of a year. To illustrate, assume that the shoe machine is purchased and placed in service on October the 1st of 2018, and the annual accounting period ends December 31st. Because this machine is purchased and used for 3 months in 18, the calendar year income statement should report depreciation expense of the machine for that part of the year. Normally, depreciation assumes that the asset was purchased on the first day of the month nearest the actual date of purchase. This means 3 months depreciation is recorded in 2018. Using straight line depreciation, we compute 3 months depreciation as $450 as shown on this slide. So you would just take the amount per year, multiply by the percentage of the year by, however months it was. So in this case, 3 over 12. So you get the amount then that of depreciation expense over that period. Now, depreciation is based on estimates of salvage value and useful life. If our estimate of an asset's useful life and or salvage value changes, what should we do? The answer is to use a new estimate to compute depreciation for current and future periods. You can't go back and change what happened in the past, but you can do for the current moving forward. So change in an accounting estimate reflects related to revised plant asset only affects current year and future financial statements. We don't go back and restate prior year statements. Let's return to the machine described in Exhibit 8.8 using straight line depreciation. At the beginning of the asset's third year, its book value is $6,400, computed as $10,000 minus $3,600. Assume that at the beginning of its third year, the estimated number of years remaining in its useful life changes from 3 to 4 years, and its estimate of salvage value changes from 1,000 to 400. Straight line depreciation for each of the 4 remaining years is computed as shown above. Thus, $1,500 of depreciation expenses recorded for the machine at the end of the third year through 6 years, each year of its remaining useful life. Asset impairment. Some companies report both the cost and accumulated depreciation of plant assets on the balance sheet. Many companies also show plant assets on one line with the net amount of cost less accumulated depreciation. When this is done, the amount of accumulated depreciation is disclosed in a note. When there is a permanent decline in the fair value of an asset relative to its book value, the company writes the asset down to this fair value. This is called an asset impairment. Assume equipment has a book value of $800 and a fair market value of $750. Thus, a $50 decline in market value meets the impairment test. So we'll distinguish between revenue and capital expenditures and account for them. Plant assets require maintenance, repairs, and improvements. We must decide whether to capitalize or expense these expenditures. So revenue expenditures are called income statement expenditures, or costs that do not materially increase the plant asset's life or capabilities. They're recorded as on the current year's income statement. Capital expenditures, also called balance sheet expenditures, are costs of plant assets that provide benefits for longer than the current period. They increase the asset and are reported on the balance sheet. Revenue and capital expenditures. So you have ordinary repairs are expenditures that keep an asset in normal good operating condition. Ordinary repairs do not extend an asset's useful life or increase its production beyond original expectations. Examples of normal costs of cleaning, lubricating, adjusting, oil changing, and replacing small parts of a machine. Ordinary repairs are revenue expenditures. This means their costs are reported as expense on the current period income statement. Betterments or extraordinary repairs are capital expenditures. So betterments, also called improvements, are expenditures that make a plant asset more effective more efficient, or productive. A betterment often involves adding a component to an asset or replacing one of its old components with a better one, and does not always increase the asset's useful life. An example is replacing manual controls on a machine with automatic controls. One special type of betterment is called an addition, such as adding a new dock to a warehouse. Because a betterment benefits future periods, it is debited to the asset account as a capital expenditure. The new book value less salvage value is then depreciated over the asset's remaining useful life. Extraordinary repairs are expenditures extending the asset's useful life beyond its original estimate. Extraordinary repairs are capital expenditures because they benefit future periods. Their costs are debited to the asset. Again, ordinary repairs are expenditures to keep an asset in normal, good operating condition. And again, they don't extend the asset's useful life or increase its productivity beyond original expectations. Their cost reported as expenses in the current period income statement. So you would have a debit for repairs expense for whatever it was, and then a credit usually to cash or whatever paid for it. Now, betterments or improvements, also called improvements, are expenditures that make the plant asset more efficient or productive. Because a betterment benefits future periods, it is debited to the asset account as a capital expenditure. The new book value less salvage value is then depreciated over the asset's remaining useful life. So you would have a debit, for example, to machinery, and then credit to cash. But it wouldn't be, because it's increasing whatever it is that it was done to. Okay, we'll account for the disposal through discarding or selling an asset. So disposals of plant assets occur in one or three basic ways: discarding, sale, or exchange. The general steps in accounting for the disposal of plant assets are described in this slide. After we dispose of a plant asset, the first thing we do is update depreciation to the date of disposal. After completing the update, we can prepare the journal entry. We do so by recording a debit to the cash account if cash was received, or credit the cash account if cash was paid by the company. In addition, we must determine whether a gain or loss is associated with the asset. A gain is recorded with a credit, just like revenue, and a loss is recorded with the debit, just like an expense account. We complete the entry by removing the plant assets cost from our books as a credit and remove the related accumulated depreciation with the debit. Let's see how we calculate the gain or loss associated with the disposal. If the amount of cash received is greater than the book value of the asset, cost less accumulated depreciation, a gain is associated with the disposal. If the cash received is less than the book value of the asset, a loss will be recorded. When the amount of cash is exactly equal to the book value of asset, there will be no gain or loss in connection with the disposal. Now, let's look at the specific example of disposal of a plant asset. So discarding plant asset, and the asset was fully depreciated. So a plant asset is discarded when it is no longer useful to the company and it has no market value. To illustrate, assume that a machine costing $9,000 with accumulated depreciation of $9,000 is discarded. When accumulated depreciation equals the asset's cost, it is said to be fully depreciated, zero book value. The entry to record the discarding of the asset is shown on this slide. And so we see that you would debit the accumulated depreciation machinery for $9,000, you would credit machinery for $9,000. Now, this entry reflects all four steps in Exhibit 10.15. Step 1 is unnecessary because the machine is fully depreciated. Step 2 is reflected in the debit to accumulated depreciation and the credit to machinery. Because no other asset is involved, Step 3 is irrelevant. Finally, because book value is zero and other asset is involved, no gain or loss is recorded. Discarding plant assets not fully depreciated. So how do we account for discarding an asset that is not fully depreciated or one whose depreciation is not up to date? To answer this, consider equipment costing $8,000 with cumulative depreciation of $6,000 on December 31st of the prior fiscal year. This equipment is being depreciated using the straight line method over 8 years with zero salvage. On July 1 of the current year, it is discarded. Step 1 is to bring depreciation up to date. This requires the entries shown above. So we see in this example a debit to depreciation expense of $500, and then the credit to depreciation, accumulated depreciation equipment for $500, because that reflects the amount of depreciation from January to the current period. Now, step 2 through 4 is reflected in the second and final entry. This loss is computed by comparing the equipment's $1,500 book value, so 8,000 divided by, 8,000 minus 6,000 minus 500, with the zero net cash proceeds. The loss is reported in the other expenses and losses section of the income statement. Discarding an asset can sometimes require cash payment that would increase the loss, because sometimes you have to pay in order to have it hauled off or to have it to be dismantled. So in this example, recording the discarding of the asset, you would debit the accumulated depreciation of equipment, $6,500, and then the loss on disposal equipment, $1,500, and then credit the equipment, $8,000, because that's what removes it from our books. Okay, selling plant assets at book value. Companies often sell plant assets when they restructure or downsize operations. So to illustrate the accounting for selling plant assets, we consider BTO's May the 31st sale of equipment that cost $16,000 has accumulated depreciation of $12,000 at December 31 of the prior calendar year. Annual depreciation on this equipment is $4,000, computed using straight line depreciation. Step 1 of this sale is to record depreciation expense and update accumulated depreciation to March 31st of the current year. So we see step 1 is to update depreciation, so we will debit the depreciation expense $1,000, credit the accumulated depreciation for the equipment $1,000, and that's just for 3 months of the depreciation within that period. So now steps 2 through 4 can be reflected in one final entry that depends on the amount that was received for the asset sale, in this case $3,000. So we would debit cash the amount of $3,000 because we're receiving cash, debit the accumulated depreciation equipment $13,000, that's to remove that from our books, and then we will credit the equipment $16,000 because that removes it. And so that is the sale of equipment with no gain or loss, because that was what the book value of it was $3,000. So now the sale of book value. If BTO receives $3,000 cash, an amount equal to the equipment's book value as of March 31st, book value is $16,000, subtract $12,000 minus $1,000, no gain or loss is recorded, and so that was what was shown above. Now, as before, so this is the same thing but above book value. As before, you must bring the depreciation up to date as of March 31st. The journal entry is to debit depreciation expense for $1,000 and credit accumulated depreciation equipment for the same amount. The balance of the accumulated depreciation account is now $13,000. And so sale above book value, if BTO receives $7,000 on the amount that is $4,000 above the equipment's $3,000 book value as of March the 31st, again is recorded, and so that is shown. So you receive cash, debit of $7,000, debit of the accumulated depreciation equipment, $13,000, and then credit gain on disposal of equipment, $4,000, and then credit equipment, $16,000. So below book value. As before, we must bring the depreciation up to date as of March 31st. The journal entry, again, is to debit depreciation expense $1,000 and credit accumulated depreciation equipment by the same amount. The balance in the accumulated depreciation account is now $13,000. And so sale below book value. If BTO receives $2,500, an amount that is $500 below the equipment's $3,000 book value is shown on December 31st, a loss is recorded. And so that entry would be a debit to cash in the amount of $2,500, a debit to loss on disposal of equipment of 500, a debit to accumulated depreciation equipment 13,000, and then a credit to equipment of 16,000. Okay, so account for natural resource assets and their depletion. Natural resources are recorded at cost, which include all expenditures necessary to acquire the resource and prepare it for its intended use. Depletion is the process of allocating the cost of a natural resource to the period when it is consumed. Natural resources are reported on the balance sheet at cost less accumulated depletion. The depletion expense per period is usually based on units extracted from cutting, mining, or pumping. This is similar to units of production depreciation. So cost determination and depletion. Let's consider a mineral deposit that has an estimated 250,000 tons of available ore. It is purchased for $500,000 and we expect zero salvage value. The depletion charge per ton of ore is $2, computed as $500,000 divided by 250,000 tons. If 85,000 tons are mined and sold in the first year, the depletion charge for that year is $170,000. The depletion of natural resources. Now, if a company extracts and sells 85,000 tons during the year, depletion expense will be $170,000. And so you figure that out by taking the 85,000 tons to multiply by $2 a ton. The journal entry to record depletion is to debit depletion expense mineral deposit of $170,000 and to credit accumulated depreciation mineral deposit for the same amount. Period end balance sheet reports the mineral balance as shown on this slide. Since all 85,000 tons of the mined ore are sold during the year, the entire $170,000 of depletion is reported on the income statement. If some of the ore remained unsold at year end, however, the depletion related to the unsold ore is carried forward on a balance sheet and reported as ore inventory, a current asset. Altering our example, assume that of the 85,000 tons mined in the first year, only 70,000 tons are sold. So we record depletion of 140,000. So that's 70,000 tons divided by the $2 depletion per unit, and the remaining ore inventory of 30,000. So that's 15,000 tons multiplied by $2 depletion unit as shown. So in this case, we would have a debit to the depletion expense mineral deposit and an ore inventory debit of 30,000, and then credit for the accumulated depletion of the mineral deposit, 170,000. Now, plant assets tied into extracting. Mining, cutting, or pumping natural resources requires machinery, equipment, and buildings. When the usefulness of these plant assets is directly related to the depletion of a natural resource, their costs are depreciated using the units of production method in proportion to the depletion of the natural resource. For example, if a machine is permanently installed in a mine and 10% of the ore is mined and sold in this period, then 10% of the machine's cost, less any salvage value, is allocated to depreciation expense. The same procedure is used when a machine is abandoned once resources have been extracted. If, however, a machine will be moved to and used at another site when extraction is complete, the machine is depreciated over its own useful life. Okay, account for intangible assets. Intangible assets are non-physical assets used in operations that give companies long-term rights, privileges, or competitive advantages. Examples are patents, copyrights, licenses, leaseholds, franchises, goodwill, trademarks, and right to use asset lease. Lack of physical substance does not always mean that an intangible asset. Notes and accounts receivable, for instance, lack physical substance, but they are not considered intangibles. An intangible asset is recorded at cost when purchased. Intangibles can have limited lives or indefinite lives. If an intangible has a limited life, its cost is expense over its estimated useful life through a process called amortization. If an intangible asset has an indefinite life, meaning no legal, competitive, economic, or other factors limit its useful life, it should not be amortized. If an intangible with an infinite life is later judged to have a limited life, it is amortized over that limited life. Okay, so compute total asset turnover and apply it to analyze a company's use of assets. One important measure of the company's ability to use its assets effectively and efficiently is total asset turnover. Total asset turnover is equal to the net sales for the period divided by the average total assets. The average total assets is computed by taking the beginning balance of total assets and adding the ending balance and dividing the result by 2. We express Starbucks' use of assets in generating net sales by saying it turned its assets over 1.56 times during the current year. This means that each dollar in assets produced 1.56 of net sales. Is a asset turnover of 1.56 good or bad? All companies want a high total asset turnover. Interpreting the total asset turnover requires an understanding of company operations. Some operations are capital intensive, meaning that a relatively large amount is invested in plant assets to generate sales. This results in a lower total asset turnover. Other companies' operations are labor intensive, meaning that they generate sales using people instead of assets. In this case, we expect a higher total asset turnover. Starbucks turnover is higher than that of Jack in the Box. However, Starbucks total asset turnover decreased over the last 3 years. To maintain a strong total asset turnover, Starbucks must grow sales at a rate equal or higher to its total asset growth, and will account for the exchange of assets. Many plant assets, such as machinery, automobiles, or equipment, are exchanged for newer assets. In a typical exchange of plant assets, a trade-in allowance is received on the old asset and the balance is paid in cash. Accounting for the exchange of assets depends on whether the transaction has commercial substance. An exchange has commercial substance if the company's future cash flows change as a result of the exchange of one asset for another asset. In an asset exchange, if it has commercial substance, a gain or loss is recorded based on the difference between the book value of the asset given up and the market value of the asset received. Exchange of a commercial substance, a loss. A company acquires $42,000 in new equipment. In exchange, the company pays $33,000 cash, trades in old equipment. The old equipment originally cost $36,000 and has a cumulative depreciation of $20,000, which implies a $16,000 book value at the time of the exchange. We are told this exchange has commercial substance and that the old equipment has a trade-in allowance of $9,000. This exchange yields a loss as computed above. Let's assume the same facts as in the preceding asset exchange, except that the company pays $32,000 cash to $23,000, not $33,000, with the trade-in. This exchange has commercial substance. The old equipment has a trade-in allowance of $19,000. This exchange yields a gain as computed on the rightmost gain columns of Exhibit 10A.1. The gain is computed as asset received minus asset given equals $42,000 minus $39,000 equals $3,000. We also can compute the gain of trade-in allowance minus the book value of asset given equals $19,000 minus $16,000 equals $3,000. In our case, so this is journal entry for a loss. In our case, the book value of the two assets given up, book value of old equipment plus cash, are greater than the market value of the assets received. So we recognize a loss of 7,000. The journal entry is debit equipment for 42,000 new because you're receiving equipment. Debit the loss on exchange of assets of 7,000. Debit accumulated depreciation equipment 20,000. Credit equipment 36,000. That's for the old equipment, and then credit cash for 33,000. So exchange, again, recording a gain. So let's assume the same fact as in the previous asset exchange, except that the company pays $23,000 cash, not $33,000 for the trade-in. We are told that this exchange has commercial substance and that the old equipment has trade-in allowance of $19,000. This exchange yields a gain as computed in the rightmost gain column of Exhibit 10A.1. The gain is computed as asset received minus asset given equals 42,000 minus 39,000 equals 3,000. We can also compute the gain as trade-in allowance minus the book value of the asset given. So 19,000 minus 16,000 equals 3. The entry to record the asset exchange is shown on this slide.